Okay, let's unpack this. When we talk about the undisputed giant of the Thai banking industry, the institution that consistently emphasizes rock-solid stability and an enormous corporate client base, BBL Bangkok Bank, is always, well, number one.
Absolutely. For decades, they've been known for their deeply conservative approach, earning them that nickname, the Fortress of Stability.
And that reputation is critical, especially today. The global economy remains highly unpredictable, and domestically we're seeing elevated risks across the retail lending sector.
Right. So the key question we are addressing for you today is fundamental. Can BBL actually leverage its foundational strength, its deep corporate relationships, and its industry-leading asset quality shield, that coverage ratio, to successfully navigate potential crises and capture the accelerating regional growth?
That's exactly the mission of this deep dive. We've got fresh data, particularly focusing on the recently announced Q3 30725 financial performance. We need to evaluate whether those fundamental factors truly support its reputation.
And crucially, why the market seems hesitant to fully recognize that value.
Exactly. We've got 5 specific financial areas to cover that will answer whether BBL is truly built to last and built to grow in this new economic environment. Right. Let's start with the headline number then, which provided a significant, almost startling surprise to the market. Bangkok Bank reported a net profit for Q3 2025 of 13,789 million THB.
Now that number, in isolation, is strong.
Yeah, it's solid.
But the context is what makes it a massive beat. It wasn't just a strong quarter. It was, frankly, a phenomenal one that defied expectations.
How much better are we talking?
Well, that result was up a solid 16% quarter-on-quarter and 11% year-on-year. And for context, broker expectations, the general market consensus, they were blown out of the water.
Really?
Yeah, one report I saw noted that BBL outperformed the market consensus by a massive 27%. 27%. This profit beat signals much more than just good lending. It indicates successful revenue diversification.
Okay, so exactly. When we look beneath the hood, the outperformance wasn't driven by a massive increase in traditional loan interest income?
No, not primarily. The main factor pushing profitability was a massive surge in non-interest income, or non-NII. That category was the unexpected hero this quarter.
Non-NII. So what specifically within that?
Well, if we look at the specific components, it's clear BDL is succeeding at diversifying its cash flow away from being solely dependent on lending, which is, a good sign. 2 factors really stand out.
Okay.
First, there was substantial trading income, specifically gains from measuring the fair value of investments, which analysts refer to as FVTPL.
Right, FVTPL. Let's pause on that FVTPL term because it sounds overly technical. What does that actually mean for the average investor listening?
It's a crucial distinction, yeah. FVTPL, or fair value through profit and loss, essentially means BBL's own investment portfolio performed exceptionally well during the quarter, likely due to the global market recovery.
Okay.
Think of it this way. Instead of making profits solely from the interest you pay on your mortgage, the bank is making a large, potentially one-off profit from playing the financial markets themselves. This type of income is typically volatile.
Right, can't always count on that.
Exactly. But in Q3 2025, it provided a significant and powerful injection of capital. Really boosted the numbers.
So a large chunk of this beat came from their investment savvy. Smart timing, maybe? But what about a more sustainable diversification stream? Something more predictable?
Right, and that brings us to the second, and perhaps more important, driver. Fee income. Fee income improved notably, up around 8% quarter-on-quarter.
Okay, that's more like it. What drove that?
This was driven primarily by bancassurance, so selling insurance policies through the bank's branches and digital channels, and also asset management services. This growth demonstrates BBL's consistent effort to monetize its vast client base, both corporate and retail, without taking on additional credit risk. That makes it a much more resilient source of future revenue, you see.
Definitely more sustainable than market timing.
Okay.
Now, here's the counterbalance to that good news. The strong profit came despite some measurable weakness in the bank's traditional core business, net interest income, or NII.
Yes, and this is where the macroeconomic challenges become visible. NII was weaker, and this is entirely attributable to the ongoing dynamics of the interest rate cycle. We saw the tangible impact of policy rate cuts.
Which compresses margins.
Exactly. It compresses the bank's net interest margin, or IN, especially after BBL quickly reduced floating loan rates to support its customers, which, is responsible, but it hits the NIM.
Can you quantify that pressure? What does a change in NIM mean in real terms for them?
Absolutely. The NIM net interest margin is, it's the difference between the interest the bank earns on loans and the interest it pays on deposits. It's the bank's core profitability metric.
Got it.
Our sources indicate NIM dropped from 3.30% in Q4 2024 down to 3.03% in Q1 2025. That 27 basis point drop is significant.
Yeah, that's noticeable.
It signals that BBL is earning less relative to its assets, and it reflects the broader economic environment where lending growth might be slower and interest rates are softening. And adding to this pressure was a measurable repayment of short-term revolving loans, which temporarily shrunk the overall loan book size.
Wow. Okay, so that makes the achievement of 13.7 billion THB profit even more impressive. They essentially offset significant pressure on their core lending business with stellar performance in wealth, insurance, and investment management.
Pretty much, yeah. They've managed to pull it off.
Now let's look at capital efficiency. How does BBL measure up on return on equity, or ROE?
Right, ROE. Key measure of how effectively management is using shareholder money. BBL's capital efficiency is steady and respectable. Analysts forecast ROE to be around 8.28% for 2025, ticking up slightly to maybe 8.38% in 2026.
So steady but not spectacular growth there.
These numbers show healthy deployment of capital and, importantly, conservative risk-taking, which aligns with their whole fortress image. But the real story, as we often see, is the market's perception of this value.
And here's where we transition to the valuation puzzle. Because when we look at forecasted valuation ratios for 2025, specifically the price-to-book value, or PBV ratio, it's forecasted at only 0.5x, half.
That PBV of 0.5.
Yeah.
That is the single most compelling piece of data in this entire analysis, I think. PBV tells you what the market is willing to pay for the bank's net assets, its book value.
And 0.5 means?
Trading at half its book value for an institution universally recognized for stability and superior asset quality.
Oh.
It's historically low. It positions BBL as arguably the cheapest stock in the entire peer group.
Which raises the critical question, why? Why is the market undervaluing a fortress?
That's the challenge, isn't it? Why would investors demand such a deep discount? Is it skepticism about future growth, maybe? Or is it a preference for banks with higher liquidity, maybe faster retail penetration?
Could be.
It's likely a combination. The market often discounts stable, low-risk banks because they lack the, let's say, aggressive growth trajectory of some competitors. And if the market is worried about NIM compression, that weakness in NII we just discussed, it might price in slower future earnings growth.
But for value investors?
Well, for value investors, this low multiple presents a potentially phenomenal opportunity. The core argument from the analysts is pretty clear. BBL is fundamentally strong, defensively superior, but currently undervalued. That suggests an attractive buying opportunity based on quality and discount alone.
Okay, moving from the financial results to the defense strategy. BBL's entire reputation hinges on its risk management. So this means we absolutely must scrutinize the asset quality, especially since the market is still jittery about rising debt levels across the region.
Precisely. If you claim to be a fortress, your defense line must be impeccable. Let's look at the NPL situation, the non-performing loan ratio.
Yeah, what's the latest there?
As of Q1 2025, the ratio stood at 3.0%. Now that's a slight increase from the 2.7% recorded at the end of Q4 2024.
Okay, 2.7 up to 3.0. Seeing NPLs rise usually triggers alarm bells for investors, right?
It often does, yeah. So we need to understand the nature of this increase. Is this a new sign of broader economic deterioration impacting new loans, or is this something more contained?
What's the analysis saying?
The deep dive suggests the issue is localized and, crucially, managed. The NPL increase stems mainly from what analysts refer to as the relapse of previously restructured debtors.
Relapse. Explain that.
Okay, so during past periods of economic stress, BBL, like all banks, restructured loans to keep businesses and individuals solvent, gave them some breathing room. Now, some of those loans, after that period of grace, have unfortunately reverted back to non-performing status. They couldn't quite make it back.
But for the average investor, seeing NPLs rise from 2.7% to 3.0% is still a red flag. Why should we trust BBL's assessment that this is merely a relapse and not a sign of deeper trouble in their corporate portfolio?
That's a fair question. It's because the critical context here is that these loans are known quantities. BBL had already anticipated risk for this group of debtors.
So they knew these were weak.
Exactly. And crucially, they had already established significant loan loss reserves against them. This means the NPL increase is largely accounted for and provisioned against, requiring minimal new provisions. It does not reflect an unanticipated shock or widespread deterioration in the quality of their newer, large corporate lending book, which, by all accounts, remains robust.
Okay. That context is vital. It shifts the narrative from a potential surprise crisis to more of a predictable, managed flow-through. So how confident is BBL in managing these future risks, particularly regarding the cost of provisions, the credit cost?
They seem highly confident. They have set a very ambitious credit cost target for 2025, aiming to reduce it significantly to a range of just 0.9–1.0%.
0.9 to 1%. What was it before?
That is a substantial decrease from the 1.3% costs seen in 2024. It reflects the bank's internal belief that its current asset quality is stable and that reserve buffer is more than adequate.
That said, we notice some analysts are maintaining a slightly more conservative view. Why the caution on their part?
Well, external analysts recognize the bank's strength, but remain cautious due to the sheer volume of external uncertainty out there. Geopolitics, global slowdown fears.
Right.
So, for example, some firms assume a slightly higher credit cost, perhaps around 1.1% or say 110 basis points. They do this to factor in global volatility. Geopolitical risks were explicitly mentioned in some reports, which might require management to hold extra overlay provisions, just in case.
Sensible, a prudent approach.
It is, ensuring that BBL is insulated even from unforeseen global shocks.
Okay, this brings us neatly to BBL's signature strength, the piece of data that truly defines the fortress,
Right.
the loan loss reserve coverage ratio.
Ah, yes. This is the real story of BBL's financial defense. The coverage ratio measures the proportion of reserves the bank holds against its existing non-performing loans. And BBL's ratio is, well, it's staggering and industry-leading.
How high are we talking?
Our sources cite figures ranging powerfully from 284% all the way up to as high as 334%.
334%. Let's use an analogy to illustrate just how massive that is. What's the average ratio for their peers? What are other banks holding?
The contrast is dramatic. One report noted the sector average coverage ratio was around 185% in Q3 2025.
So 185% versus potentially 334%.
Exactly. To put that into perspective for you, imagine the average bank has enough insurance money set aside to cover $1.85 for every $1 of bad loans on their books. BBL, at 334%, has enough to cover $3.34 for every single dollar of bad loans. It is nearly double the peer average. It's huge.
Wow. When you see a number like 334%, it almost feels like overkill. Has BBL historically paid a price for being too conservative? Does it drag on returns?
That's a sharp question. And yes, sometimes that's the argument. Maintaining such a high reserve absolutely ties up capital that could otherwise be lent out, generating interest, or returned to shareholders via dividends or buybacks. But in a volatile environment like today's, this high coverage provides BBL with substantial strategic flexibility and, simply put, the best asset quality defense among its peers. This immense buffer acts as a strategic war chest.
So strategically, what does this high coverage allow them to actually do? What's the benefit beyond just safety?
It gives them immense power, really. It means BBL can weather a far deeper and longer recession than its competitors without needing to raise capital or significantly damage its profits. That's the defensive part.
Okay.
Furthermore, offensively, if economic conditions stabilize or improve, they have the potential to release some of these excess reserves back into earnings. That would effectively lower their credit costs dramatically.
Boosting profits unexpectedly.
Precisely. And potentially surprising the market with stronger net profits down the line. So this high coverage is not just safety, it's also a latent source of future profit. It gives them options.
So, we've established BBL is playing an impeccable, highly conservative defense, a true fortress. Now let's pivot from stability to offense. Where is the aggressive growth coming from over the next 3 to 5 years, especially since their core NII is under a bit of pressure?
Right, good question. The growth engine is explicitly defined as corporate and international business, particularly focusing on the dynamic ASEAN region. That's where they're placing their bets.
Okay, and what are the targets?
BBL has set an overall loan growth target for 2025 of 3.45%. Now, crucially, our sources note that this target is actually the highest among the major Thai banks.
Oh, interesting. Highest target.
Yes, which signals strong internal confidence in their specialized lending segments, even while the overall economy might feel sluggish.
And the composition of that target, I assume it reinforces the corporate giant strategy. Less focus on retail.
Absolutely. They expect the corporate and international business segments to drive the higher end of that 3–5% growth range. That's the engine. In stark contrast, they are maintaining very cautious, conservative targets for SME and retail lending.
What are those?
Aiming for just a modest 1–2% growth there. This risk mitigation philosophy really complements their strengths. Focus on large, stable corporate clients and regional expansion, while minimizing exposure to the higher default risk inherent in the domestic retail sector right now.
Smart. Play to your strengths. So the grand strategy, therefore, revolves around the massive structural tailwind of foreign direct investment, or FDI, into ASEAN. BBL seems uniquely positioned to capitalize on this global movement.
They are arguably the best positioned, yes.
Yeah.
Largely due to their historical relationships and the extensive regional network BBL has cultivated over decades. You can't build that overnight.
And the scale of this FDI shift.
Yeah.
It's significant, right?
The macro context here is staggering and vital for you, the listener, to grasp. FDI inflow to ASEAN has surged. This is primarily driven by global supply chain diversification companies moving production out of historical centers like China.
The China plus one strategy we hear about?
It's exactly that kind of thing. Over the last decade, FDI into ASEAN has increased by 300%. 300%. And it now accounts for a substantial 17% of total global FDI flows.
Wow. A 300% jump in FDI is not a cyclical trend. That feels like a permanent tectonic shift in global economics. How does BBL translate that macro movement into actual unique lending advantages over, say, competitors like K-Bank or SCB, who are also strong banks?
Yeah, that's key. BBL's network and history matter profoundly here. They often serve as the primary financier for large multinational corporations, particularly Japanese and Chinese firms, that are relocating or expanding their manufacturing and logistics hubs across the region.
So they have the existing relationships.
They do. Their competitors may focus heavily on domestic market penetration, which is fine, but BBL's established footprint in countries like Vietnam, Indonesia, Singapore, that allows them to provide seamless cross-border financial services to these massive FDI projects. They are literally following the supply chains as they diversify across borders.
So it's not just about offering loans, it's about strategic partnership and helping clients navigate these new global realities like deglobalization.
That's exactly right. BBL is proactively preparing its liquidity and products to support clients adapting to two major global shifts. First, as you said, deglobalization or supply chain diversification.
How do they help there?
Well, BBL assists clients with complex trade finance, cross-currency needs, and navigating the different regulatory compliance hurdles as they move and set up shop across multiple ASEAN nations. It's complex stuff.
And the second shift?
The second is digital transformation. BBL is actively lending for major technological and business improvements in key high-growth sectors within the region.
Okay, what specific high-growth sectors are they targeting with this lending? Where's the money going?
They are strategically targeting areas that benefit from long-term national policies and regional trends. Think energy, especially renewable projects supporting the transition to lower carbon operations.
Green finance?
Yes, green finance is a big part. Also hospitality, as tourism rebounds and regional travel accelerates, and the bioindustries. For example, BBL is actively issuing green loans to drive the low-carbon transition, funding things like solar panel installations for industrial complexes or major efficiency upgrades for manufacturing facilities.
So it's targeted.
Very targeted. The strategy isn't passive lending, it's targeted support for clients undergoing transformative change, often linked to these FDI flows.
Got it. Now, beyond just the numbers and growth, investors increasingly look at long-term, non-financial stability factors. BBL's commitment to ESG seems integral to their whole fortress reputation.
It is essential, yes, both for maintaining investor trust and, increasingly, for accessing the growing pool of capital earmarked specifically for sustainable finance. BBL has achieved the prestigious ESG AAA rating, which is the highest tier available.
AAA rating, that's top marks.
It is. And this commitment underpins their claim of long-term responsible growth.
Can you give us some concrete examples of their governance commitment? What does that look like in practice?
Well, their governance is tightly structured to protect the fortress, as you'd expect. This includes robust anti-corruption measures, stringent PDPA compliance for data privacy, very important these days, and mandatory, rigorous cybersecurity training for all staff to address the ever-evolving digital threats.
Okay.
All these elements solidify their reputation for high corporate standards, ensuring that their growth is not only profitable, but also sustainable and ethically sound over the long haul. It's part of the package.
Okay, so we've reviewed the strong Q3 earnings beat, the fortress-like balance sheet defined by that unparalleled coverage ratio, and the clear high-growth strategy anchored in ASEAN FDI. So what does this all mean for the stock price? What are the professional analysts concluding from all this?
Well, the consensus view is overwhelmingly positive. It really reflects confidence in BBL's fundamental value proposition. The latest IAA consensus, which surveyed 16 different brokers,
16, okay.
shows strong bullish sentiment at 87.5%. That breaks down into 10 outright buy recommendations, 4 hold, and only 2 sell ratings.
10 buys, 4 holds, 2 sells. So pretty skewed positive. What about those holds?
Yeah, the few hold ratings seem generally driven by short-term valuation concerns after the recent price run-up, rather than any fundamental distrust of the bank or its strategy.
Right, and where are they setting the bar for the stock price over the next year? What's the target?
The consensus average target price for 2025 is a 167.4 THB. However, this is important, you need to be aware of the wide range of predictions here.
Oh, how wide?
It indicates some disagreement on the pace of BBL's growth and maybe its ability to maintain that high non-NII income we saw in Q3. The estimates run dramatically from a low of 119.000 THB all the way up to a high of 196.000 THB.
Wow, 119 to 196. That's a huge disparity, a difference of over 70 THB per share. What accounts for that wide range? Are the bearish analysts really focusing on the Numen compression we discussed earlier?
Precisely. Analysts setting those lower targets down near 119 often place greater weight on the short-term drag from NII weakness. They might also be skeptical about the sustainability of those FVTPL gains that boosted Q3 the trading income.
Thinking it was a one-off.
Possibly. And they might also be factoring in a slower than expected resolution of those NPL relapse issues we talked about. Takes time to work through.
Okay, makes sense. And the bull's hitting 196.
Conversely, analysts setting the high targets, like those we saw from Trinity or InnovestX, are clearly betting heavily on BBL successfully capturing that long-term regional growth opportunity in ASEAN. They believe in the FDI story.
And the coverage ratio buffer?
Yes. Coupled with the potential for credit cost release from that massive coverage buffer, they see that as potential future earnings power.
Let's look at some specific broker targets then. You mentioned InnovestX and Trinity.
Yeah, InnovestX maintains a strong buy with a 180 THB target price. Trinity also holds a buy with a slightly higher target of 185 THB.
Okay, 180, 185. Pretty bullish.
Both firms essentially view the bank's low PBV, that 0.5 times ratio we keep coming back to, as an indefensible discount for an asset of this quality. They're suggesting significant upside is already baked into the fundamentals, provided BBL hits its growth targets.
We know the stock looks fundamentally undervalued, but what's the immediate short-term catalyst that might push that price closer to those higher targets? What gets it moving now?
The immediate and probably most powerful catalyst is the high potential for dividend upside and improved capital management overall.
Ah, the dividend.
Yes. BBL's immense capital position, bolstered by those high reserve ratios and recent profits, means management is actively considering managing that capital more actively. That could mean either increased dividend payouts or potential share buybacks.
Both good for shareholders.
Absolutely. These moves directly signal confidence from management and immediately reward shareholders. It puts cash in their pockets or reduces the share count.
That immediately grabs the income investors' attention. What are the expected dividend yields looking like?
Analysts are forecasting very attractive yields, competitive even among high dividend banking peers. The forecast currently stands at around 5.80% for 2025. And it's expected to strengthen further to about 6.14% for 2026. Specifically, the market seems to be pricing in a significant second half 2024 2H67 dividend payout of 6.5 THB per share.
6.5 bat, okay.
This expected increase in payout is widely viewed as the short-term factor most likely to stimulate the stock price leading up to the actual announcement. The market knows BBL is sitting on a lot of capital, maybe too much, and investors expect to be paid for that stability.
Right, so to give the listener the necessary tactical data points, let's quickly look at the technical context, the chart picture. The latest price we have is 158.50 THB based on data from late October 2025. So that gives us a good current anchor point.
Okay, 158.50. Considering that price, where does BBL sit within its recent trading history? High end, low end?
Well, the stock is traded in a 52-week range from a low of 131.0000 THB up to a high of 161.50 THB.
So 158.50.
It's currently performing very well then, near the top of its range.
Exactly. It has rallied significantly on that strong Q3 earnings report we discussed. and it's actually been leading the ASEAN index during what's been a generally cautious market period. This confirms the positive fundamental sentiment is currently translating into price momentum.
Okay. What are the key technical indicators suggesting for the short-term outlook, particularly if this momentum continues? Is it overbought?
The short-term technical sentiment is actually very strong. Many short-term models indicate a strong buy rating for, say, the one-week outlook. But for strategic investors, understanding the support and resistance levels is critical for timing. The immediate consolidated support level, which is crucial for maintaining this recent uptrend, sits firmly around the 155-156 THB zone.
155 to 156. So if the price holds above there, the momentum is confirmed.
That's the idea, technically speaking, yes.
And what about resistance? Where might the stock face selling pressure or struggle to break through on the upside?
The near-term resistance levels, according to technical analysis, are firstly around that 161.50 THB mark, which is the recent 52-week high. That's the first hurdle.
Makes sense.
And then looking higher up, potentially around the 189-190 THB mark. Reaching that 189 THB level would signal the market is really starting to price BBL much closer to the high end of that wide analyst consensus range we talked about.
Okay. So given the strong fundamental buy rating, but the stock's current proximity to its 52-week high, what is the strategic advice for you, the investor listening? Should one rush in and chase the price here at 158.50?
Analysts are almost unanimously advising against chasing the price right now. The rapid rally following the Q3 beat has, understandably, temporarily pushed the stock into a perhaps slightly expensive range based on short-term metrics.
So wait for a pullback.
The strategic recommendation is patience. Yes, investors should probably look for accumulation opportunities waiting for minor dips, perhaps seeing a price point closer to that support level of 155 THB maybe later this year or early next year.
Why is that patience so crucial right now? Why wait?
Because the main near-term catalyst we identified is that annual dividend announcement. If you acquire the stock at a lower entry point, closer to 155 say, you maximize the yield you capture when that expected 6.5 THB dividend is potentially announced and paid out.
Better yield on cost.
Exactly. It's a quality stock you likely want to own for its long-term stability and regional exposure, but maximizing your entry point is key to realizing the full potential of that historically low PDV valuation over time. Don't overpay just because it's moving now. #outro.
Okay, that brings us to our final synthesis. BBL absolutely lives up to its name as a fortress of stability. It boasts industry-best asset quality and coverage ratios, that incredible 394% shield we discussed, that provide a massive defense against domestic economic bumps and global volatility.
Definitely. But critically, it's not just defensive. As we laid out, it has a clear, powerful offensive strategy anchored in its corporate focus and that massive multi-year structural tailwind of ASEAN FDI.
That duality is compelling. Exceptional stability combined with strategic regional growth ambition. The analyst consensus is a resounding buy, driven by those strong fundamentals and, critically, the extremely attractive valuation multiple, the PBV, of 0.5x.
Which analysts believe just cannot be sustained given the quality of the underlying assets. It seems too cheap for what it is.
Indeed. So, considering BBL's superior balance sheet strength and its strategic focus on capturing the regional boom, here's a final thought for you to mull over. What will ultimately be the greater driver for its stock price over the next year? Will it be its defensive strength in a volatile global rate environment, perhaps allowing it to release provisions and stabilize earnings surprisingly well? Or will it be its offensive success in actually capturing that multi-year ASEAN economic expansion, delivering on that aggressive 3-5% loan growth target?
Defensive resilience versus offensive execution. That is the strategic tension for you to consider as you look forward with BBL.